reset. So,
All right, well, thank you for taking the time to attend. We're going to talk today about the future of personalized portfolios. I'll just give you a very brief background into what Nebo Wealth is. Nebo Wealth is a new venture that's been incubated in a well-established institutional asset management firm, Grantham, Mayo Van Otterloo, GMO, otherwise known. And over about the past decade or so, what started as a project has now evolved into a venture, and I'm going to talk to you about our story and where we're headed. So I'm going to start with sort of high level. There are two mega trends in the industry. One of those trends is, and this is sort of an economy-wide trend, that consumers are expecting more and more personalization of products and services. And in the wealth management industry, that's no different. On the other side of things, you have financial advisors who are expecting and demanding more scalability and more efficiency out of their practices. The problem is there's a trade-off between these two components. You can either have personalization or you can have scalability, but you can't have both. And in particular, when it comes to portfolio construction, advisors really only have two options. You either have to choose personalization or you choose scalability. So let's start by looking at personalization. What does personalization typically look like? Personalization typically looks like the advisor has an identity, they have a philosophy, and they incorporate that into spreadsheets. And as you can see by example here on the screen, which is a screenshot of a call that we did with a prospect who became a client, those spreadsheets can get quite complicated. In this example, the advisor was using a time bucketing approach to build personalized portfolios for each prospect that came through the door. This time bucketing approach embeds the advisor's identity. So there's a personalization that the advisor is doing at the client level, but there's another layer of personalization which is really important as well, and that's personalization for the advisor. The advisor has to have a vehicle to express their philosophy with respect to financial planning and asset management. And that's an important component. But basically what happens is, if you're following a spreadsheet-based approach, over time these spreadsheets become more and more difficult to manage and update. And you end up in this miserable situation of what we call spreadsheet misery. The other option is to go to the other end of the spectrum and to really embrace this idea of model portfolios. And model portfolios are scalable. So the idea is that you construct a set of multi-asset class portfolios, you do some analysis on the client, and then the client gets assigned to one of these model portfolios. So let's look at this in a little more detail. Let's look at the example of a retirement client, a 401k plan participant. And let's look at two participants. So we have two participants here, participant 1 and participant 2. They differ relative to their fundamentals. They differ in terms of income, they differ in terms of savings rate, they differ in terms of account balance. Yet, because they are of the same age, they have the same current age and they have the same target retirement age, they own the same portfolio. What about advisory clients? So here's another example. You have client 1 and client 2, different ages now, one's 30 and one's 60, different income, different savings rate, different account balance. However, they have the same risk tolerance score. They have the same risk tolerance score, they have the same portfolio. So here we have 4 clients, different fundamentally, but they end up with the same portfolio. Now this is not a random one-off. We talk to a lot of advisors, and the advisors are not shy about telling us that 90% of our clients are in our moderate model, and we know that's not the right answer. So I just want to take a little bit of a historical aside here, and The two prime problem, which I just outlined, was actually one of the original motivations for starting this project 10 years ago. 10 years ago, actually more than 10 years ago now, Ben Inker, who's the head of asset allocation at GMO, came down to my office and he said, I just had a call with one of our large corporate clients, and they're starting to do more work in the defined contribution space. They want to know if we have any thoughts about glide paths. Maybe you want to look into glide paths. So I started looking into glide paths, and what really struck me right away was the purveyors of glide paths were not explaining what they were doing. They were not explaining how they were building the glide paths. And that's what motivated us to go back to first principles, which I'm going to elaborate on, next, and really think about the problem from the perspective of the asset owner. And the perspective that we're bringing here is the asset owner's portfolio should be primarily driven by their needs and circumstances. And one way to frame this problem that we're seeing, where you have different clients with the same portfolio, is there's a gap between the plan and the portfolio. The clients differ in their financial planning characteristics, yet they have the same portfolio. So that means that there is a gap between the plan and the portfolio. Now, the industry knows that this is a problem. The industry knows that this gap exists. Here's a quote from Eric Clark, former CEO of Orion, back in 2021, who said, as an industry, we need to focus on solving investor problems and move beyond focusing so much on the investment problem. This is the idea that we need to bring the asset owner and put ourselves in their shoes and put them front and center. Now, we also know that this is a problem. How do we know this is a problem? Because advisors are telling us that this is a problem. We've run a number of webinars over the last few years, and we ask them a question. We ask them, do you observe a gap between financial planning and asset management? And a whopping 89% say yes, they observe a gap. It's hard to imagine 89% of advisors agreeing on anything, but there you have it. We also ask them, do you struggle aligning your client's financial plan with their investment portfolio? And more than half of them say they struggle. What's really interesting about this is the industry has known about this problem for decades. So here's a book from 1985, Charlie Ellis, Investment Policy. And in chapter 4, he talks about a paradox that is haunting investment management. The paradox is that funds with very long-term purposes are being managed to meet short-term objectives that may be neither feasible nor important. And they are not being managed to achieve long-term objectives that are both feasible and worthwhile. In these two sentences, the essential problem, the essential tension between the long-term and short-term is being captured, as well as the importance of making sure that you're solving the right problem for the client. This problem has still not been solved. So the industry knows it's a problem, we know it's a problem, and everybody's known for decades it's a problem. Why hasn't it been solved? It hasn't been solved because it's a really hard problem. It's a really hard problem because it's a hard portfolio problem, but it's also a people problem. You have complicated clients, you have chaotic markets, and you have advisors that are caught in between complicated clients and chaotic markets. Complicated clients and chaotic markets means that the problem is also not a static problem. Clients change, markets change. Do you have a system and a framework for adapting to the changing client conditions and the changing market conditions, and are you confident in that? But it's much worse than that. And it's much worse than that because it's also a theory problem. Modern portfolio theory, which sort of underpins the entire conceptual framework for portfolios, is just not up to the task. And the reason it's not up to the task is because of how it thinks about risk. It thinks about risk as volatility. This one-dimensional view on risk is really tied to the notion that we saw before, that you have one parameter driving the primary asset allocation, which filters down to the portfolio for the client. So you have this one-dimensional view on risk. But clients are not one-dimensional. Clients are multi-dimensional. So you go to the CFA curriculum, and you look and see what does the CFA curriculum say about the investment policy? There are three primary pillars to an investment policy: time horizon, target return, and risk tolerance. So how do we take those three components and incorporate that into a coherent framework? Well, we need to think about risk. We need to rethink risk. We need to rethink risk from the perspective of the asset owner. Put ourselves in the shoes of the asset owner. What is the most important thing that matters to them? The most important thing that matters to them is they don't have what they need when they need it. And that's incredibly powerful. It's so simple, but incredibly powerful. Why? Because when you ask the question, what do you need? You automatically bring the target return into the problem. You're not bearing target return under things like we call risk capacity. It's front and center. When you say, when do you need it, you're bringing time horizon directly into the problem. Two of the primary pillars of the investment policy statement are just right there in front of you by asking a simple question: what do you need and when do you need it? And it's not that volatility doesn't matter. Volatility is important. It's an important characteristic of the portfolio. And I could probably spend 3 hours up here explaining how you should be thinking about volatility, that volatility is a cost, not a risk. It's the cost that you need to bear in order to minimize the risk that you don't have what you need when you need it. But I'm not going to bore you with that. Suffice it to say that it embeds this notion of risk tolerance, and it's very easy to incorporate that into the portfolio construction framework. All you have to do is either impose a maximum weight in stocks or a maximum weight in bonds. So rethinking risk and framing risk as not having what you need when you need it is the key to bridging the gap between the plan and the portfolio. And the key is, so once you embrace this idea of risk, then the natural follow-on is, why don't we build portfolios to minimize this risk? Those portfolios are going to maximize the likelihood that the client achieves their goals and objectives. So we call this a goals-based portfolio construction engine. Why is it goals-based? It's goals-based because of how you frame the question: what do you need and when do you need it? You need to understand from the client what their goals and objectives are. That gets embedded into the cash flows. Now, we're not trying to reinvent financial planning. We are trying to integrate with what advisors are already doing on the financial planning side, but reframing this in terms of really minimizing the risk that matters most to the asset owner. All right, so we've come a long way. We're replacing modern portfolio theory. But let's go back to where we started. We started with this trade-off between personalization and scalability. This goals-based portfolio construction engine is a key ingredient in unlocking a framework and a platform to deliver both personalization and scalability. But it's not enough. And it's not enough because there's an operational component and an investment component that has to be integrated into this. So this leads to the next idea. To understand this next idea, let's go back to our model portfolios. So we start with this idea that we've got, an array of model portfolios, and the seeds of the answer are actually embedded in these model portfolios. So the idea is actually really simple. You take the model portfolios and you extract, you disassemble them into their asset class building blocks. And you can do that to any level of complexity that you would like. We have some advisors who have very simple investment menus, investment schemas, investment frameworks. We have others that have very complex investment menus and schemas. And there's no limit to how you can disassemble as long as you've got these structural building blocks, and they can be very simple as you want or as complex that you want, and cover the entire spectrum of the investment landscape. The beauty is that once you have these building blocks, when you combine that with this goals-based portfolio construction engine, that can power personalized portfolios for every client with no more work than it takes to manage model portfolios. So I'm going to pause here because this kind of reminds me of those of of those dot pictures. You see a dot picture, you stare at it for a while, and either you see sort of the image, the three-dimensional image behind it, and you recognize the power of that. This chart looks so simple, but once you see the truth behind it, once you see the power of unlocking the combination of scalability and personalization, you can't unsee it. So the result is personalized portfolios, scalable, in a way that amplifies the client experience. And it's amplifying the client experience because you're starting with the most important question. What do you need when you need it? So to sort of illustrate that this is not some unrealistic fantasy, here's a quote from one of our early adopter users. Before Nebo, we customized client portfolios around 5 proprietary model allocations. So this is an example where the 5 model portfolios that I was showing you were not off-the-shelf models. The advisory firm was building those model portfolios. They were just not happy. They were an example. 90% of our clients are in the moderate model, and we know that's not the right answer. So now, Nebo can deliver over 100 unique, personalized client model portfolios, truly elevating our clients' experience without taking any more of our team's time or resources. So this is how you get to the advisory firm's promised land. Personalization at scale. Goals-based portfolio construction engine combined with firm-specific building blocks. Those firm-specific building blocks are really important because they embed the identity of the advisor and the advisory firm, and that is critical. We see that every day. The advisors are selling themselves, their identity, their services to their client, and that has to be preserved, and they want a platform that allows them to express that. Okay, so I've sort of laid out at a very high level the conceptual components of how this platform works and how you get this combination of personalization and scale. So one of the things I think that's really caught us by surprise as we've been working on this, really over the last 4 or 5 years, we spent a lot of time with advisors. They've really helped build what we have. We started with the dopiest prototypes that you could ever imagine and engaged with them and said, do you buy this concept? Yes, they love the concept. Okay, what do we need to add to this so that you'll use this every day in a way that will deliver what you need? So one of the comments that comes back is that Nebo is magical. So it's not magic. So what are some of the things that sort of elicit this kind of response? So one example is we have a cohort of advisors who believe very strongly that as time horizons grow, stocks become sort of relatively less risky to bonds. Now, there's a huge debate in the investment world about whether or not that's true. And I have my opinion, but that's not the point. The point is, that's part of the advisor's identity. And that advisor wants a platform and wants that notion expressed in the portfolios for their clients. They can't get that anywhere else. That is embedded into the fabric of Nebo. You can turn it on, you can turn it off. You don't have to believe it, but you can also understand what the implications are if you believe it or if you don't. Another example, which is somewhat related, is this notion of capital market assumptions. So we're talking to a very large RIA, and they have, they're large enough where they have their own investment research team, so they have their own capital market assumptions, and they have advisor-facing clients. So early last year, their capital market assumptions for fixed income rose a lot. So they changed the portfolios as a consequence. But when they took those new capital market assumptions and they took it to the financial planning side, those new capital market assumptions got propagated for the next 40 years. and they dramatically changed the output from the financial planning system in a manner that they were unable to explain to their clients why their portfolios had changed so much. It's a dramatic illustration of this gap between financial planning and asset management. Once you allow for short-term capital market assumptions to be different from long-term capital market assumptions, and you have a coherent way of interpolating between them, you don't have that problem. That's some of the sources of the magical comment. We had another one, I had a come to Nebo moment. So this was, we had a meeting with a client after he'd spent a late night working on Nebo, and we see that quite a lot, that the advisors are using Nebo, they become very attached to it. And the problem that he was struggling with was he would make a tactical move from an implementation standpoint, but was getting really hung up about what the implications of that were from an asset allocation perspective. And once you embrace this sort of building block approach, it sort of offers you a layered view of the world. So with Nebo, he was much more directly able to understand when he makes an implementation decision, how is that going to filter up through the rest of the process? Now, we think part of the reason why we're seeing such an emotional response, it goes back to the question that we asked, do you struggle aligning the plan with the portfolio? And more than half of people say they struggle. Well, that struggle is a strong word. So if we can help them understand what they need to believe to own a portfolio for a client, what do they need to believe about a client? What do they need to believe about the markets? We can significantly improve their understanding, lower the emotional content of the decision-making process, and ultimately allow them to make better decisions over time and repeat that over time. Because remember, clients are complicated and markets are chaotic, and they're going to be changing on a constant basis, and you're constantly having to make decisions to update the portfolio for changing needs and circumstances and market conditions. Okay, so where does that leave us in terms of where we are today? So we mentioned this concept of advisors giving us feedback. One of the strong pieces of feedback has been, can you give me the easy button? And so our announcement here at T3 is adding trading and rebalancing to the array of the sort of wealth management assembly line that we've put together to sort of complete that process. So if you sort of unravel all of the things that Nebo is doing, and it sort of does them in this almost nonlinear, iterative manner, but if you unroll them, Nebo's doing, it's not really doing personalized financial planning. We have light financial planning. We have some really interesting things that we're doing there, like you can model the Blanchett's model, for example, if you want to. But we're not trying to reinvent financial planning. We integrate with the e-monies, the money guides, and the right capitals, et cetera. So you've got a planning component, you've got this asset allocation component, you've got these asset class building blocks, which is now starting to tie into asset management. You've got investment selection. This platform is fully open architecture at every level. It is the advisor and the advisory firm's asset management platform. And the thing that we've added is now trading, rebalancing, and reporting. So the easy button. So what can Nebo do for advisors? There's so much Nebo can do. It's sort of a Swiss Army knife. I'm not going to bore you with each of these specific items because I really want to emphasize a primary point, is that what Nebo does for the advisor is increase the confidence that they have that they're putting the client into the right portfolio. And the reason that that's happening is because the advisor has a much deeper understanding of what is going into that portfolio, a much deeper understanding of the client, and a much deeper understanding of the markets. And from the advisory firm's perspective, what Nebo enables and empowers is a common purpose. So one of the things that we hear about from advisors is that as practices are growing and expanding, there can be incoherence and inconsistency across advisors. Nebo gives a common purpose and common habits to keep everybody on the same page. We see use cases now where the conversations with the clients are being changed in fundamental ways. Not only is that driving referrals, but it's also driving increases in wallet share. Differentiated value proposition, there's reporting capabilities. We talked about this sort of investment policy notion. We don't think of that in terms of investment policy statements. We think of what Nebo provides is an investment policy process that you can continuously document over time. And what can Nebo do for clients? So ultimately, this is where we started. This whole thing started by putting ourselves in the shoes of the asset owner and asking, what is the primary risk that the asset owner faces? The most important thing here is that you're starting with the right question. What does the client need and when do they need it? And you have a systematic framework tailored to your investment philosophy and your planning philosophy that enables you to make better decisions over time, that is ultimately going to lead to better outcomes for the clients. And at the core of it, and we see this feedback extensively, is the advisors are going into this conversations with clients with a lot more confidence and building a lot more trust, and doing so in a lot less time than in the past. Instead of having 90-minute conversations over 3 weeks, 3 times over 3 weeks, they can get the point across in 20 minutes. And the client leaves with a much higher degree of confidence, and so does the advisor. And with that, I'll take questions. Well, if you're interested in finding out more, you can come down to our booth. You can visit our website. You can send us emails. We're available, and I appreciate your time.